In 1981, the top marginal tax rate in America was 70%. By 1988, it was 28%. That is the single largest tax cut for the highest earners in modern American history, and it came with a promise attached: cut taxes at the top, and the money will flow down through investment, wages, and jobs. 40-plus years and trillions of dollars later, we have the data to check that promise against reality. It does not hold up, and I am going to show you exactly where it breaks. Start with the mechanism, because the theory itself is not stupid on its face. Supply-side economics argues that lower taxes on high earners and corporations increase investment, which increases productivity, which increases wages. Economist Arthur Laffer illustrated this with a simple curve showing that tax rates can theoretically get so high that cutting them raises revenue by growing the economy faster than the rate cut shrinks it. Ronald Reagan built his 1981 economic plan around this idea. The problem is not the theory. The problem is what actually happened when it was tested, repeatedly, for 4 decades. Look at wages first, because wages are the entire point of the theory. Since 1979, worker productivity in the United States has grown more than 70%, according to the Economic Policy Institute. Inflation-adjusted hourly pay for typical workers grew a little over 10% in that same window. If tax cuts at the top genuinely trickled down into broad wage growth, these two lines should move together. They do not. They diverge almost immediately after 1981 and never reconnect. Now look at what corporations actually did with tax savings when they got them, because we have a clean, recent test case. The 2017 Tax Cuts and Jobs Act cut the corporate tax rate from 35% to 21%, the largest corporate rate cut in decades. Companies did not primarily respond by building factories or raising wages at scale. In 2018, the year immediately after the cut, S&P 500 companies executed roughly $1 trillion in stock buybacks, a record at the time, according to S&P Dow Jones Indices data. Buybacks return cash directly to shareholders by boosting share prices. They do not build a factory. They do not hire a worker. The Joint Committee on Taxation and the Congressional Budget Office both scored the 2017 tax law as adding an estimated $1 to $1.9 trillion to the federal deficit over 10 years, even after accounting for any growth the cuts generated. That is the nonpartisan scorekeepers of Congress itself concluding the growth did not pay for the cut. This is not an outside critique. It is the government's own accounting. If you want a smaller, sharper experiment, look at Kansas. In 2012, Governor Sam Brownback slashed state income taxes and eliminated taxes entirely on certain business income, calling it a real-live experiment in supply-side economics at the state level. He predicted a shot of adrenaline into the Kansas economy. Instead, state revenue collapsed by hundreds of millions of dollars a year, credit rating agencies downgraded the state's debt, and Kansas underperformed neighboring states on job growth for most of the following 5 years. In 2017, the Kansas legislature, controlled by the governor's own party, voted to reverse the cuts, overriding his veto to do it. And here is the historical inversion that trickle-down advocates rarely address directly. The decades most associated with broad, shared prosperity in America, roughly 1950 through 1973, had a top marginal tax rate of 91% for most of that period, dropping to 70% by 1965. Average annual GDP growth during that high-tax era was around 4%. A 2012 nonpartisan Congressional Research Service analysis by economist Thomas Hungerford examined the relationship between top tax rates and economic growth across 65 years of data and found no statistically significant correlation between the two. Lower top rates did not reliably produce faster growth. Higher top rates did not reliably slow it down. So where did the money actually go, if not into broad wages and growth? Back to the wealth concentration data. The top 1%'s share of total household wealth has climbed from roughly a quarter in the early 1980s to close to a third today, according to Federal Reserve figures. Corporate profits as a share of GDP have grown substantially over the same period, while labor's share, the portion of national income going to workers rather than capital, has trended downward across most of the developed world, not just the United States. None of this means every tax cut in history failed, or that every increase succeeds. It means the specific, sweeping claim, that cutting taxes at the top reliably trickles down into broad-based wage and job growth, has been tested directly and repeatedly since 1981, and the data consistently shows the money pooling at the top rather than flowing down. That is not an opinion. That is the Joint Committee on Taxation, the Congressional Budget Office, the Economic Policy Institute, and Kansas's own legislature, all independently pointing at the same result. If you want more breakdowns where the data does the talking, the receipts behind the political talking points, subscribe and hit the bell, because I run these numbers every week. And tell me in the comments, has a tax cut ever actually trickled down to you? See you in the next one.